virtual event. And without further ado, I hand over to my colleague, Richard Hopkin, who will lead us through the rest of today's. Richard, thank you very much indeed.
Thank you very much, Michael. Welcome, everybody. My name is Richard Hopkin. I'm Managing Director and Head of Fixed Income at AFME. And it's my great pleasure today to introduce you to our keynote speaker, Mr. Luis Garicano, MEP. As you heard, Mr. Garicano is a member of the European Parliament, the head of the Ciudadanos delegation, and Vice President of the Alliance of Liberals and Democrats of Europe and the group Renew Europe. He obtained a bachelor's degree in economics and law from the University of Valladolid. He also holds a master's degree in European Economic Studies from the College of Europe, and both a master's degree and a PhD in economics from the University of Chicago. Before joining politics, he was a full-time academic. He is currently on leave from IE Business School, where he was Professor of Economics and Strategy. And before that, he was a full Professor of Economics and Strategy at the University of Chicago and the London School of Economics and Political Science. He is also a research fellow at the Centre for Economic Policy Research in London. He will address us today on the topic of addressing the SME solvency crisis. Mr. Garicano, please forgive my terrible pronunciation of the beautiful Spanish language, but welcome, and we are looking forward to your remarks.
Thank you, Mr. Hopkin. I actually don't have any complaints. Your presentation was exactly right, so not a problem at all. Welcome, everybody. Thanks to AFME and thanks to the AB, etc., for their invitation. It's great to be here. I'm looking forward to a good discussion. I know these are tricky topics, but I look forward to an interactive discussion. I'll set up the stage with my remarks and with my speech, with my keynote speech, and I look forward to your questions as well. So the main issue I want to talk about is the solvency crisis faced by small and medium enterprises in Spain. All of you know that SMEs represent 99% of the companies in Spain, around 75% of employment, and close to two-thirds of economic value added. Only Italy among European countries has similar size distribution. This is complicated for innovation and for progress in many dimensions, employment, training, etc. But it's particularly tricky for bad times because SMEs tend to have limited buffers, limited funding sources, and they have been very vulnerable to the COVID crisis. If they disappear, you can imagine what a tragedy would be for employment, etc. As you know, as in many places in Europe, the problem right now is kind of frozen. We don't have a lot of knowledge about how bad it's going to get because it is kind of all the financing is kept in place through liquidity lines, etc. But we can get some senses of where we are, give a diagnostic, and give some solutions. It goes without saying that if we don't solve it, then the SMEs go bankrupt, then the banks are filled with non-performing loans, and then the Spanish state, and the other European countries which have similar problems are forced to step in. So what's the magnitude of the change? Last week, the Bank of Spain published an outstanding report. The title was very soft. Those in the Bank of Spain watching me will be smiling. They did a careful job, but they didn't want to kind of worry people excessively, but the underlying numbers were quite worrying. According to the study, the share of vulnerable SMEs has gone up from 20 to over 35%, 75 increase during the COVID crisis. But in some sectors, particularly leisure, hotels, restaurants, is probably up to 70%, according to the Bank of Spain, the share of vulnerable companies. I want you to picture this, right? You go through a street in Madrid with all the beautiful tapas places and all the beautiful restaurants, and two-thirds of the places you see are at risk of disappearing. So the number of insolvent SMEs could be over 1 in 5 to 1 in 4, and in some sectors it would go significantly higher. That's why it's really essential to act soon, and we need to stop this kind of unraveling before it starts, right? We don't want this problem to remain unaddressed and over the next months to see an avalanche of cases in mercantile courts, zombie loans, bankrupt SMEs, bad loans in the banks, and to start to place Spain again in the eye of the storm. We can't see all those jobs, all those bankruptcies come in and destroy the economic tissue of Spain. And this is what I say about Spain is true about Europe as well. We must act now to solve the solvency crisis before it takes over, and it's really difficult to deal with it. So what are the solutions and what are the kinds of things that I would propose that Spain needs to know? I would say that there are three key pillars. I've been writing a lot in Spain about this and trying to push public opinion. Some of these things have been starting to enter the policy debate. As you will see, today was a day of big announcements as well. The first pillar is to improve the insolvency frameworks for small and medium-sized enterprises. The second pillar is to improve debt restructuring procedures. Right now, restructuring processes are horrendous for small and for large, for individuals. It's really bad. It is very paperwork intensive. It's really difficult to get rid of the debts. Still, the Spanish Civil Code says debtors are responsible for all their loans, for all their debts, with all the current and future good property. So assets. So it's basically a really punitive system where it's really hard to get out of. And third, the implementation of state aid, and much more direct aid from the state, which, as I was telling you, we've seen today partly. So a big problem for Spain and for many European countries that we are identifying and that we want to address. Some recent data from the Bank of Spain that gives us a sense of the magnitude. 2 in 3 companies in the leisure, SMEs in the leisure hospitality sector, and a set of solutions that I want to briefly address before I lose your attention. The first priority is the function of the judiciary and extrajudiciary insolvency procedures. For small businesses, as I said, there was a liquidity problem early in the pandemic. We all thought 2, 3, 4 months, it's easy to sustain them. There was credit lines from the ICO, people who are in the Spanish financial sector or close know what it is. It's the Spanish Official Credit Institute. It's a Spanish public sector bank, basically, which has opened credit lines and new credit lines to provide backing for private sector debts. These are usually with 20% of bank involvement, 80% of state involvement. The state only kicks in when the insolvency, when a non-performing loan actually happens. This debt was supposed to start with a couple of months of inactivity, but it has gone up to like current levels are at to 12 months of inactivity. So these are significant to very large debts for many small and medium-sized enterprises. And as Mario Draghi recently said, he said that the problem is much worse than it seems. The bankruptcy moratorium has allowed this hibernation to continue. There's been a 15% decrease, interesting to note, in number of companies that filed for insolvency in 2020. But of course, that doesn't reflect the reality of what is actually happening. The reality is that the destruction of company has been preventing by putting the whole economy into an induced coma, where we need to now make sure that we wake up the economy and we can get things going. And to do that, what is crucial is a good insolvency framework. Pre-insolvency and bankruptcy procedures are essential, and I don't need to tell it in this setting, because they allow for differentiation between highly indebted viable companies who are potentially temporarily insolvent but have good business opportunities, and need a debt restructure from non-viable companies that are going to be insolvent no matter what. So what we want to try to do is to eliminate that debt overhang that is going to be making it very, very hard for companies to continue performing and for companies to continue functioning and creating jobs and creating wealth. However, so the insolvency procedure is the solution. The actual problem is that Spain doesn't really have one. And definitely not for the level of insolvencies that we're anticipating. According to the Bank of Spain, in 2019, there were 13 attendants for each 10,000 companies versus 108 in France, 76 in England, 6 to 8 times more. So the use of pre-insolvency mechanisms for self-employed and small companies is really even more scarce. When you look at self-employed, you only have 93 extrajudicial payment agreements between 2015 2020. I repeat, 93 process. We've only seen 93 prejudicial or extrajudicial deals in 5 years, 18 per year. So that is just ridiculous. So we need to move fast. We need a more agile and less expensive emergency procedure to solve this insolvency problems, crisis, and only that is going to allow us to get this problem sorted. The European Directive on Preventive Restructuring, which has to now be transposed, is basically the big opportunity to do that. It's supposed to be transposed between July 2021, and it is an excellent opportunity to rethink the existing framework. It's really urgent, and I would hope that Spain will use that chance to adapt the insolvency process and to solve the problems that we are identifying here. There is a second aspect to the opportunity, which is the fact that we now have the RRF, the Recovery and Reconstruction Resilience Framework in Europe Fund. The Fund for Reconstruction and Resilience is essentially a very large 750 billion, of which really almost 400 billion is fresh money that Europe raises in the market and that uses to condition and to help countries to undertake reforms. The truth of the matter is, it hasn't been on the top of the radar of the Commission when talking about reforms, but I would like to suggest that in the case of Spain, there is no reform that would be more useful at this point. I would hope that with the transposition of the directive and with the presence of an opportunity like conditioning loans on reforms, we would have a much better framework. And that's point number one. We need a bankruptcy framework, an insolvency framework, a restructuring framework, and an pre-insolvency restructuring framework that actually is fit for purpose. We don't have that right now. The second pillar that we need is a set of incentives for debt restructuring. More than the legal process, it's the money, right? And the main incentive I want to point out is we need to involve the state in public creditors in those restructurings. Up to now, there's one creditor who doesn't actually get into any of these restructuring processes, who is the state. Social security debts and tax debts exist forever. And of course, that's one of the big reasons why restructuring is not more popular in Spain. If the small businesses have mainly two types of creditors, one is the bank, one is the government. The bank, they own loans, but to the government, they own tax fees, social security. And until now, it cannot be renegotiated. So if you don't stick into the bankruptcy set of debts that are subject to bankruptcy to the bankruptcy pool, the debts with the state, the public debt, you're not getting anything done. Olivier Blanchard, how do we do that? Of course, that's going to lead to huge corruption. How are we going to get the state to actually renegotiate debts with people who owe money? Who is going to renegotiate those taxes and that social security in a way that is efficient and actually gets the right return? Olivier Blanchard, as I was saying, has given the best solution, I think, and it basically means that public creditors accept similar haircuts as private creditors, and it's the banks who negotiate. So the state says to the banks, okay, I'm willing to come in. I don't really know what I'm doing, so I'm trusting you, the bank, to align my incentives to yours by saying whatever you accept, I will accept. If the bank thinks that there's nothing to gain by restructuring, the bank won't do it. If the bank thinks there is something to be gained, it's more aligned with the state than otherwise. So there is also an economic rationale to accept bigger public haircuts than the private creditors, and the reason is that there is a different social and private value to the firm. The firm is also preserving employment opportunities, respecting and protecting the unemployment insurance schemes, etc. But the important thing is that they are both automatically linked, what the bank is offering and what the state offers. I would say that the banks do need to get involved. I can imagine that some banks will be worried. I am not defending what Calvino was suggesting. The minister was very recently just wanting to restructure the eco loans with bank involvement. I can see why the AEB and the ABED, Asociación Española de Banca, and banks are worried about giving signals that suggest that the banks are going to be losing lots of money with this new wave of restructurings. I'm not talking about the generalized restructuring. I'm really talking about getting the banks to have some skin on the game in special, targeted, clearly determined circumstances where the state also comes in. I would say that, as I was saying, a generalized haircut based on some solvency metric would be counterproductive and potentially lead to misallocation of capital, and restructuring haircuts need to be defined case by case. Second, we need aid to improve the solvency of the self-employed. Direct aid is not just the eco loans, and so considering taxes, considering Social Security could help as a form of direct aid. And so I think that Europe has a role. I think that Europe needs to be involved. I think Europe needs to say, look, we're willing to step in and help by using the incentive, the carrot and stick that the RRF is for Spain, to say, if Spain wants this money, it needs to solve the insolvency procedure and to put some skin in the game, both Spain and the banks. The third pillar that I want to consider on helping the SMEs get out of this mess is direct aid. We need some support for the firms that can survive. I've been saying it for many months, and I can announce that today the Prime Minister has said that he was putting together an 11 billion package, as other European countries have done. The European Commission has said that the Spanish umbrella can help with this, that state aid to a set of businesses are going to be allowed as part of the temporary framework to cover the fixed cost of businesses. So it would take the form of direct grants, tax and payments. It would provide liquidity to companies that are experiencing declines of 30% or more, and it would cover fixed costs up to 10 million. I am very happy to encourage the implementation of this direct aid. My political party and myself have very much been asking for this, and I'm glad to see that this is happening. We need to help entrepreneurs get around this corner. We need them to get to the light at the end of the tunnel. And that's why I think these three measures, improved insolvency proceedings, better debt restructuring involving the public and private creditors, and the implementation of direct aid is essential. There are many other things that we can talk about, the RRF, the idea of a pan-European or national bad bank, but these are, I think, the main issues that I want to highlight and that I think are going to be essential to the solvency of the financial sector and to getting our entrepreneurs out of this hole. Thanks very much, and I'm very happy to take your questions.
Thank you, Mr. Garicano. That was a very comprehensive and thought-provoking survey, I think, of what needs to be done to help the SME sector in Spain. And as you rightly say, SMEs are the foundation of the economy. You know, we all hear about the great big multinationals and the big national champions, but when you look at where the employment is and the key part of economic activity, it's the SMEs that are absolutely key. I think that's true across Europe, but particularly I think in Spain. Perhaps I would encourage questions from the audience. But before we go to those, perhaps I could kick off, if I may, with a warm up question. We have about 10 minutes, I think, to play with. By background, I am a securitization practitioner, so I noted with interest that you were a shadow rapporteur on the capital markets recovery package for securitization at the end of last year. And a key part of that, as we all know, was the new framework for STS, or simple, transparent, and standardized securitization for on-balance sheet securitizations, sometimes referred to as synthetic securitizations, although personally I don't like the description synthetic. I think on-balance sheet is much better. Now, on-balance sheet securitizations, I think, are particularly important in the SME sector, because SME loans are actually quite difficult assets to securitize in the cash markets, because they tend to be very diverse. There's often a link of some kind, to other business that the customer does with a bank. They're sometimes revolving facilities. So they're not impossible to do as cash securitizations, but speaking from my own experience, they can be quite tricky. So the on-balance sheet tool is I think particularly important and could help a lot in enabling banks to free up the credit risk. Bearing that in mind, and I'm sorry, I'm getting to my question. Bearing that in mind, why do you think the securitization recovery package had such a tough journey through the Parliament and actually through the Council? Because there were some quite harsh, I would say, kind of restrictions put on the original Commission proposal. And as someone who also worked on the original securitization regulation 5 years or so ago, I was slightly taken by surprise that the Parliament and the Council hadn't yet, if not quite learned to love securitization, become more accustomed to it. So I'd be very interested to hear from you the political sort of mood behind that, which would be, very important for all of us in the market to understand better, I think. Sorry, it's such a long-winded question.
No, it's an extremely appropriate and very much online with what we were worrying about in the discussion. I could go into the specific details, but many of them will fall under the same heading, which is making sure that the on-balance sheet securitization really does undertake significant and true risk transfer. So I think the main concern that we have, and let me just make an analogy that you and the rest of the people viewing this will understand, although it's a very different context given the changes in regulation, which is the SPVs of Citibank in 2008, right? So the special purpose vehicles of Citibank looked like Citibank had transferred very significant risk out of their balance sheet. It looked to all extents and purposes like Citibank was not actually responsible for a wide range of those risks. In fact, the moment the short term, the commercial paper, the very short term financing disappeared, all these supposedly bankruptcy remote vehicles ended up in the balance sheet of Citibank. Now, why this example? To me, the main concern that we have had has been, are we really seeing regulatory arbitrage where the bank kind of says, oh, this risk is kind of somebody else is taking care of, but the moment something bad happens, then it goes back in? Or are we seeing real true risk transfer? And many of the big discussions we had about proportional amortization, about when options that would involve call options that would involve this risk going back to the balance sheet of the bank, were about thinking carefully, do we believe that this opens the door to seeing balance sheets, bank balance sheets that look like, hey, this bank is healthy, when in fact what has actually happened is it only looks like the risk transfer took place. And I think that was the biggest part, to me at least, of the discussion. I would be curious, Richard, to hear your view on this. But this is our main concern. Are we encouraging a a real STS, a real kind of proposal that is truly going to transfer risk out of the balance sheet, or in these synthetic securitizations, which in theory are selling the risk without selling the loan, are actually not really even selling the risk.
Right. It sounds like AFME and our members have some more work to do. Yes, I would love to respond to your observations. I fear that in the few minutes remaining, perhaps we should do that offline. I mean, we have a piece of work actually that we did for one of the Spanish regulators that I'd be very happy to share with you, which goes into this whole question of, is the risk transfer genuine? How has the market changed since 2008? Perhaps we can follow up with your office afterwards on that. That is not me dodging the question. Trust me, I'm just anxious to bring other people.
No, that's right. That's right.
I see we have some questions from the floor. And I would like to go first to Juan David at Fitch, who has asked a question about the green economy. And the question is, what incentives do you envisage for SMEs to migrate and adapt towards the green economy?
Well, the big tool, obviously, the big tool for migration is the cost of carbon, the direct cost of carbon that we have through the ETS, the emission trading scheme. As you know, we've seen significantly increasing cost. It was around 25 for a very long time, pretty stable. It's been going up towards 40 euros the metric ton of CO2. It seems to me that prices are really always the main incentive, but we now have a whole set of new incentives that have to do with the recovery facility. 37% of the money that is going to be spent in the recovery facility, and let me remind you that this is something that benefits mainly Spain and Italy, Spain being almost at the same level of Italy, though it has a much smaller economy. So Spain is a huge beneficiary of this. 37% of this money has to be spent in green the economy. So my sense is that there will be a big incentive in the programs if the government does a good job, which I would hope it does, to use this dual kind of pressure from prices plus carrots and sticks that we will see over the next few years to really get SMEs to move.
Thank you. We have another question about the state aid. And the question is, how would the direct state aid reach the Spanish autonomous communities? Would they be able to provide direct aid? Gosh, I hope that's not too political a topic, but...
The government has said that even though the plan is national and the recovery plan is national, it is going to partner with the regions to get the implementation. So the regions will be very much involved with disbursing money. The current framework that the Commission has authorized is not just authorizing the central government, but it's actually the Commission is authorizing regions, municipalities, and cities and central government to undertake state aid for those losing more than 30% of it. This is all from today. So I just tell you the fresh news: 30% of loss in revenues, and I would imagine that, given the express wish of the government and given the authorization exists, it will be feasible.
That's good to hear. Thank you. And I think we have time for just one more question, which is a comparison of this crisis to the financial crisis in 2008. Of course, they're very different crises. But this question is, how will recovery from this crisis compare to the one in 2008 for SMEs. Do you anticipate a quicker rebound given sectors affected are more dynamic than construction? Of course, problems in the huge recession in the construction industry was a big part of the 2008 recession, wasn't it, in Spain? So, will this one be different? Will the bounce back be faster, I guess?
I would say if we don't score an own goal, which we are scoring right now as a country in terms of bankruptcy processes, direct aid, and helping the restructuring, I would say clearly the recovery will have to be faster. The main thing you have is a productive specialization of a large number of Spanish workers, businesses, capital towards a sector that was overbuilt, which was construction. You had to shift an enormous amount of resources from one side to the other of the economy. Right now, you don't have the wrong specialization. You don't have stranded assets in such large magnitude. You don't have stranded loans, etc. What you have is a temporary blip, a huge hole in the balance sheets for a lot of companies. If you manage to repair these balance sheets, partly with the mechanisms that Richard and me were talking about before, have to do with securitization, partly with bankruptcy and restructuring. If you manage to get rid of this hole, the large majority of the Spanish economy should work. Walk around and see one of those 70% bars that are basically insolvent and will have to close. The guy who's running the bar is making 700-800 clean a month. He is on his 50s, late 50s. The average median age is over 49. And he's perfectly happy. He has his regular customers, they come in, etc. He's never going to pay this loan. It's impossible, right? By making $100, he's not going to be able to pay, in 100 euros, not going to be able to pay what he made, what he stopped making during an entire year. But if we restructure the loan, we know the guy can continue earning his same 900 with the same customers, unlike in the 2008 recession, where we knew that 17-18% of the workers in Spain couldn't continue doing what they were doing before. So in that sense, from the perspective of the economy, this should be a positive productivity shock that should lead to more technological progress without actually making our tourism, etc., specialization obsolete, assuming we go back to normal. If the COVID crisis lasts forever, then everything that I said is wrong, of course. But assuming we go back to normal, our productive specialization works, and we can look forward to the new crazy 20 years where we all go partying, and Spain will be the party capital of Europe. People, when they want to party, I can show you. I can show you the sun coming in from my window right now. They want to party in Spain. Thanks very
Absolutely.
much.
Yes, thank you on that very positive note, Mr. Garicano. Thank you so much for your remarks. We really appreciate you sharing your time with us today. I know you're super busy, and perhaps at some point we would love to see you again, perhaps at our annual event for securitization, which is held in Barcelona each year. Fingers crossed.